Okay, so I had a few questions in the elite room about hedging, the ultimate hedge. One thing I want to show you is if you go over here to the forum and you type in ultimate hedge, there is a lot of videos on it. Okay, so you can go through here and you can click on these. What I do is I right click and I say open a new tab, right click, open a new tab. You can see video like diagnostic trading hour one. That would be where I'm like doing one live. I did one yesterday. And then there is some Q&A on there and stuff like that. So if you ever see that like a question hasn't been answered, maybe it just sort of got lost in the list, and you can say, hey, rebumping on this question, can anybody help me? That type of thing. But yeah, so if you search ultimate hedge, you can find what that video is. The video's unavailable, but we have other videos that are available. Nadex Spreads. We might want to fix that one. Cam. So anyways, there's a lot of education on it, but also I want to answer to some live questions. I've been answering those really the last couple of weeks on the last several THTs. Okay. So for hedging, you do not hedge binaries with spreads. With binaries, you don't mix the two like that. It's not a good idea. It won't work. Okay. But we've tried it, and the only way it's used is when you're hedging iron condors. If you don't know what that is, unless you already know how to trade spreads, don't worry about it. Okay. All right. So let's see what our questions are. Jason, I have a couple potential hedge trades to review with Darrell when he gets in. First is a gold short. Okay. The second is a USD yen long. Here's how it is playing out so far. All right, so let's look at this first year contract selection. On your gold short, by the way, if y'all don't know, when you're looking at the scanner over here, okay, and you select a contract, this is profit and loss. It's probably a bad example. There we go. Profit and loss. This right here is the price of that market, like in this case, NASDAQ, all right? And this is the live price of the market, the indicative Nadex price, that little black line going up and down, okay? So showing you the max loss, the max profit, where it's at on the scale, as it moves, and where the live market is, and how much you can make. That's how you read that simple little P&L chart. All right, so the one issue on this one, and maybe it was just your best choice. I mean, from the looks of it, it probably was your best choice. Is that it obviously is not going to offer you a full hedge, Jason, because this profit on this short is going to stop making money at this point right here. So that's not a horrible thing. It would just mean that when it gets closer to this, you're probably going to want to close out both sides of the trade. And I mean, by that point, it's went like 10 or 15 points against you. So, like, the trade's over. Let it go. Right? But, I mean, it's a good hedge. Just be aware that it's not necessarily covering, that section, right? All of it right there for you. Anytime that you can have the hedge match up with the floor or ceiling, or anytime that you can have the hedge even go further, than the loss, then that's a good thing, because that means you can make money if it really goes against you. So like the current position you got, like you're in 10 contracts. So you're up 240 on one side, you're down 250. You're going short. You're actually winning on the hedge, okay? Or you're winning on your direction. You're going short, so you made the right call. And the hedge is losing. And the floor of the hedge, 1220.8. With 1220 being the floor. So basically, this is right at maximum loss. So at this point now, if gold, this was earlier this morning, but if gold continues to decline, then now your short is going to continue making profit, and your hedge, your premium is going to be paid for, and that's where you really start making the money. On your dollar yen, the cool thing about this one is if you're really wrong and it goes short, then you're going for the long here, going long on US yen. But if you're wrong, then and the market and dollar yen drops, then your short could actually make more money than your long could lose, and so therefore you could make money if it goes down or goes up. But you obviously have a bias to the up. The hard part about this is it's so deep in right there that it has to move quite a bit on the trade. So, because you're going to have to make back all this premium before you start making profit. Doesn't mean you're losing it. It just means because you're only losing the difference between the two. So if when you got in the difference between the two was 8 ticks, then I mean your risk is literally $8. But you won't really make any money until it's surpassed that point. So you got to move far enough. Like past here, you'll start making profit. Move past here, start making profit. If it doesn't do either, I mean, you're risking $8. I mean, you can't get a straddle that cheap that close. I mean, that's so not bad choices. So just the closer you can get the bid and offer with the closer proximity and least risk is what you're looking for. And in this case, I mean, that was really, and it may be better than it looks. It's actually only looks like about 8 or 10 ticks. It doesn't look, well, oh no, that's more, 56 to 90. Yeah, you got to move quite a bit of ticks for that thing to really start making some money. So the issue there is you're really requiring a big move, which isn't a horrible thing, but that's also why I say hedging is not for scalping. So basically what I was showing, and just to do a quick review, so nothing was missed. There I was looking at gold, and I was showing how gold right here didn't quite cover the loss all the way. Now, just get out of the trade. You don't have to stay in it all the way. I mean, you still got a 10-point stop loss for like $10. So like $100 stop for $10. I mean, not a bad choice. And really small risk on it, which means that you'll be able to make back that. You'll be able to start making profit pretty quick. And then I was showing on the US yen that being so big that it really was going to take a large movement before he could make any money. But he could make money in both directions, which is cool, but it was really going to have to move for him to make some cash. So I probably would have been more inclined to go with a shorter expiration that I could get a better risk reward on, if possible. I know both of these right here had the exact, like in this case, the US yen didn't really move, and so you actually have the exact same contracts. And you only paid an extra $5 for another hour. So I mean, really, what's the best choice? It's just be aware that you have to have a lot of movement. But I mean, it's stress free, just letting it do its thing. You see yen, and then he's showing right now that he's about to break out in gold as it continues going short. His hedge is working perfectly. There's only $10 difference, and now the short is really ready to make money because the gold contract is really starting to make some money. And then the yen trade, it's rocking. So he's way up, and the hedge is, where's it at? The current market, at max loss. So I mean, yeah, he's making money right there. Great job. Okay, the whole point being is the hedge has hit maximum loss, and the direction that Jason is trading is either highly profitable or moving into a big profit. Okay? I don't know if you calculated your total risk correctly because I don't see a calculation that you've given me. Well, just give me your calculations. You can type them out, and you can always repost them. You don't have to wait on me to type it out. Okay, while you're typing out your calculations, I will go to the next question. Grant had a question, hypothetical example. If I'm going to go long daily and I'm hedging with something that expires in 30 minutes, which I just pulled up a screenshot of Grant's chart. Not chart, but scanner with some words on it there. With a daily, and I'm hedging with something that expires in 30 minutes, will they offset each other? Okay, Grant, I am going long with a daily, and I'm hedging with something that expires in 30 minutes. Will they both offset each other when the smaller hedge gets closer to the floor or ceiling? Okay, all spreads work the same. The closer a spread is to the middle of the spread, the faster it moves. The closer a spread is to expiration, the faster it moves. That really is the answer. And the spread that you're looking at, I guess you're going long that one, using the master spread, the widest one. Probably choose the, well, I guess it's okay. Talking about a lot of ticks. So you got the master spread, and then you're looking at hedging. Okay, one, I would turn near the market off when you're looking for your spread hedges. Okay, you should not have near the market on when you're looking for your hedge spread. So you should have any on moneyness. It could be an out of the money spread. It could be an at the money spread. It could be a near the money spread of the whole recording. So, use your near the market to choose the contract. Already have your contract chosen. Choose your near the market daily. Already know what contract you want to have. Already have your contract chosen before you start your trade. Always. Okay, before you even look at your chart, pick out the contract you're going to trade, open up the ticket, and have it ready to go. Okay, so that way when it comes up, you can place your order. And then after you placed it, now let's go over and let's put on any NA, and actually probably go to intraday. And now let's see what would be, actually let's go ahead and show all of them just so we can have that selected. But we're going to look at our intradays. So let's just say I chose this contract as my long trade. Now I can go and now I can start looking for what hedge I want. And again, the first thing to do is, I mean, you don't have to even do any math, just click. Like that right there. That doesn't look so shabby. You know, right? I mean, it's going to give me a full hedge. There's a $31 risk. So basically what's going to have to happen if the market is going to have to move 37 ticks above, which is only 3.7 points, above the ceiling of that spread, 56.70. So once the market hits 56.73, then I'll start making money. Probably a little before then, but technically at expiration at 56.73, I'll start profiting. And it will hedge me all the way to the bottom, all the way to expert, you know. So looking at other contracts, I can also get this one right here, the exact same thing. It's cheaper, but it's only going to last me for 20 minutes, which means I'll start profiting in 20 ticks, but it'll only last 20 minutes. Now, once I'm trailing, the hedge doesn't matter. Okay. My risk on the hedge again is where I buy, 5670.3 minus 5666 point, let's say 5667. So I have like a $30 risk on this trade, and it has to move about 30 bucks before I start making money. 30 for 3 points. And that's the hedge. Okay, Jason, what are your calculations? So should he close the winning side as long as the losing side is at max loss? You should close the winning side when the chart tells you to close it. The other side of max loss has nothing to do with when you close the trade. You just shouldn't close the one that's at max loss because who knows, the market may reverse, right? So based on the chart and your trailing stops or your take profits, that's when you close the winning side. If you're at max loss, just leave the thing on. Maybe it comes back. If there's still quite a bit of money left in it, then, you know, just flatten it out. You're risking no matter what. So just wait until, I mean, when your chart tells you to close, close. You don't trade any differently. There's no different rules on trading. So trade the same as if you didn't have a hedge. Just the hedge lowers your risk. Good question, though. So did you calculate your total risk correctly? If you, all you gotta do is subtract the offer from the bid. So the offer of the one they bought from the bid of the one you sold. So let's say that's 10 ticks. Multiply times the number of contracts. Say you did 10 contracts, then your risk is $100. Bought at 113.90 and you sold the intraday at 113.72, then your difference is 18 ticks. $18. If you did 10 contracts, your risk is $180. Okay? So that would be the correct formula. And then now I'm switching over to, hopefully y'all are seeing it, the USD yen, or you will see it as it populates on your side. The intraday contract. So did you choose the best one? In this case, I would say the actual better choice would have been this daily. It's cheaper. It has a closer proximity. It was a good choice, but that daily would have been even better, and it would have given you the entire day with a hedge and a massive profit the other way if you're totally wrong. My biggest issue with this one is how much it has to move before you start making money, but it worked out really well. I mean, so it was a great trade. I obviously can't bash it. Results speak for themselves. Yep, 6 ticks, $60. Yes, because I have basically every spread takes that $1 maximum. You know, every tick is $1. Where the speed of that, you know, to the underlying is relative based on where the market is in the spread. But yes, you'd want an equal ratio. But for a hedge trade, I mean, there's obviously a lot of ways to combine options. But for a hedge trade, you'd want the equal size. Now, if you're using it for, you know, another market, now Forex would actually be 1-to-1 on the dollar pairs, like euro dollar, pound dollar, Aussie dollar. And it works pretty well on like dollar CAD, dollar yen because they're pretty close to 100. On the futures, if you're using a futures contract, then you need to look at the ratios, which are built into the little hyperlink right there if you click that. But yeah, it's how to basically get a really low cost spread with a lot of upside and potential downside profit potential as well. Pretty cool little trade. And your trade can make like 190 ticks. I mean, it's a great master spread that you chose right there. Think I got everybody's questions on hedges. Is that accurate? Yes. When you calculate your risk, remember, times the number of contracts you're doing. Then, I mean, it'll oscillate a little bit with bid offer. When the market flies a little bit, you may see it go up or down, you know. And then eventually what will happen is the difference will get smaller and smaller and smaller in a good way. Well, if it hadn't profit to cover the hedge side, then you can leave the trade on, I guess. Or you can close it out and take your very small loss. You got two choices. The time that you have to exit the trade is when the hedge expires, or you don't have to if you've trailed your stop. But if it's not moved far enough, like let's say over the next hour and a half it's only moved 10 ticks and you needed to move 20 ticks, well, you can put on another hedge. You know, all that. But what you're saying is like, what if my take profit comes in, or my, you know, my trail gets hit? Well, that's the benefit of having a hedge, right? Your risk didn't go up, so you don't have to close the trade. So that's a good question. So if it keeps moving, but say it hit my take profit, but my take profit doesn't cover my hedge, there's really no benefit for me to close the trade. That would be a point that you could leave it on, because I mean, you're really trying to become profitable with the trade. So you do have that more time to be right. Now, once you are in profit, like how he was on his yen trade, when that one hits the take profit, you get out. Okay, because I mean, he has up 135, down 29 on the hedge. You know, when it's trailing stop or, you know, target level or whatever gets hit, get out of the trade. But on like gold, let's say he's down 250 on the hedge, he's up 240 on his directional position, and trailing stop gets hit, really no reason to close. So that's a great question. Thank you for bringing that up. Kelly, will you make sure that is added to the Ultimate Hedge PowerPoint? Because that's one that nobody's ever asked, which is pretty cool. Ask John to add it. Great question, Lauren. I don't know if it was recorded or not. So I've not tried spreads yet, and have yet to watch the videos, but just out of curiosity, would this be a good hedge if there was time? What are you trading right now, Nicholas? Are you trading like just straight FX? Nasdaq on Nadex Spreads? Okay, well, you are trading Nadex Spreads. I thought you just said you weren't trading spreads. Okay, no spreads on hedges yet. No, this hedge would be sort of pointless. This would be a strangle, or straddle, actually. I mean, you don't really have any risk. You're choosing low risk contracts. So, like, I mean, there's only $9 risk. The difference between the two is $8. So, I mean, really, you're just doing a straddle. You're not really hedging. Hedging would be like, yeah, like $47 risk, and you're bringing it down to like 9. You're not really lowering your risk at all with that trade. Yes, the point of a hedge is basically to lock in a maximum loss that is smaller than what your stop loss would be or what your max risk would be on a spread. So stop loss would be like on like another trade or on just an outright spread or Forex or future. So the whole point, yeah, is basically it's insurance. And you're saying, okay, I accept this much risk. And I get the speed of the trade because I'm choosing the near the market contract. And euro dollar, I mean, this is like dead period for euro dollar the last hour. That's why there's no premium in there. I put the apex pattern on just about everything. It's just one more confirmation for me to look at. Any more questions about hedges?